Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. It's late afternoon, Tuesday, February 24th, 2015, and the title of today's audio blog is The Most Unequivocally Dovish FOMC Statement in Memory. Well, okay, I'm actually starting this audio blog script midday Tuesday, 2 hours after Whirlybird Janet shocked the world, but certainly not the Miles Franklin blog, in releasing the most unequivocally dovish FOMC statement since assuming the chairmanship a year ago, and frankly the most dovish such statement since the late 2012 commencement of QE3, I should say. Given my schedule, I expect to finish it after the market close, and irrespective of what time I actually tape, the message will be the same, which is that not only did the Fed lie to the entire world last week when publication of the wildly dovish January 28th FOMC minutes completely contradicted the decidedly more hawkish message of the initial statement, but it was validated this morning in spades by an even more dovish statement. And geez, I still have to discuss this morning's so-called Greek deal, which in my view not only set new lows for political and central bank fraud, but could not have been more transparent in doing so. Not to mention the, quote, deal that was finally signed won't change a thing, as when the Greeks' 4-month extension expires in June, we'll be back where we started, with a far angrier Greek population, a collapsing Greek and European economy, and likely a far weaker euro currency, which, by the way, I predicted in Sunday's audio blog titled, Which is More Fraudulent, Gold Mining Resources or the Greek Debt Deal? To that end, as I write at noon Eastern Standard Time, the euro is about to plunge below 1.13 per dollar, and this following the aforementioned most unequivocally dovish FOMC statement in history. In memory, I should say. Heck, I even considered titling today's audio blog, What is More Fraudulent, the Greek Debt Deal or the Federal Reserve? As for the final chapter of this month's Greek tragedy, on the surface it's utterly astonishing to believe that just a month after being elected on an anti-austerity platform, or more accurately interpreted, pro-default and anti-euro, Alexis Tsipras could have forsaken Syriza's principal platform already, let alone as literally days ago he was viciously lashing out at Germany and the Troika, claiming Greece would absolutely not extend the bailouts and associated austerity. I mean, that's what politicians do. They lie about any and everything. However, the bigger point here is not said deal, which again, not only didn't fix anything, but barely kicked the can more than a few feet. No, the key takeaway here, as I discussed ad nauseum in the past week's articles and audio blogs, is that despite Greece being hopelessly broke, all parties involved are deathly scared of the catastrophic aftermath of a Grexit, which I assure you it would be, as it would certainly include a default of most, if not all, of Greece's nearly $400 billion of debt, which in turn would yield a rapidly escalating pigs crisis, derivatives mayhem, and surreal defaults across the rest of Europe, not to mention a free-falling euro currency and likely its complete or partial breakup, which in turn would dramatically weaken Europe's political and economic stability and spread its fiat cancer worldwide. Consequently, a miraculous, Hail Mary-like reform proposal at the 11th hour Monday night, which not only doesn't have a prayer of ever being adhered to, particularly amidst an expanding global recession, but wasn't even written by the Greeks. Yes, my friends, it turns out that the Greek reform document was accidentally leaked beforehand, and what do you know, it wasn't written in weekend-long, all-night sessions by Alexis Tsipras, Yanis Varoufakis, or any other Greek politician or banker. To the contrary, it was written by a veteran Euro area employee named Declan Costello, which quite obviously was simply rubber-stamped by the Greeks in a type of, sure, whatever you say agreement. Again, at this point, per what I wrote in yesterday's inevitable global sovereign debt collapse article, it doesn't matter what Greece promises at this point, as it is dead broke. In fact, it's so dead broke, we need a new Webster's definition for the term Greek broke. And that said, when one looks at said list of reforms, it's no less ambiguous than the 300 or more or so prime directives crammed into Peter Weller's brain in RoboCop 2, such as, and these are real, this is actually what's in the statement, work toward creating a new culture of tax compliance, reform VAT policy, administration and enforcement, modernize the income tax code, resolutely enforce and improve legislation on transfer pricing, modernize the tax and custom administrations benefiting from available technical assistance, whatever that means, work toward drastically improving the efficiency of central and local government administered departments, validate benefits through cross-checks with the relevant authorities and registries, phase out charges on behalf of third parties in a fiscally neutral manner, and unify and streamline pension policies and eliminate loopholes and incentives that give rise to an excessive rate of early retirements. I mean, is the entire world that stupid to believe that this list of generic reforms, which by the way would require countless years, hundreds of billions of euros, and a 180-degree change in a 5,000-year-old culture to enact, could even be started in 4 months' time, let alone amidst a nation in complete political, economic, and social chaos, with utterly zero confidence in its leaders and pure, unadulterated hatred of its Eurogroup oppressors? Of course not, as let's face it, the entire world has gone mad. And the only reason the entire European mad experiment hasn't imploded yet is that Draghi is truly doing whatever it takes to monetize every last pig's bond with freshly printed money. And likely, like his counterparts at the Bank of Japan, a healthy dollop of European stocks too. Well, I guess we'll just have to wait and see what happens 4 months from now, when undoubtedly what we witnessed in this month's Greece-Eurogroup negotiations is elevated dramatically higher. To that end, on a day when Zero Hedge has posted some of its best and worst headlines ever, which I'll get to shortly, they certainly hit the nail on the head in describing the big picture of what the Greek deal essentially entailed, i.e., what happened over the past week to the Syriza mandate is that the new government's list of unfulfillable promises to the Greek people has been replaced with a new list of unfulfillable promises to the Troika. But hooray, all's well for now, as the stock of the world's most insolvent financial institution, the National Bank of Greece, is soaring. And FYI, following this news, aside from the typical 2:15 a.m. Eastern Standard Time attacks, gold and silver prices were essentially unchanged following said Greek deal. Whilst the euro was weaker, oil barely higher, and U.S. stock and bond futures essentially unchanged. Okay, I'm almost up to Whirlybird Janet's statement. But before it, a few odds and ends to get to, starting with, what a shock! The Department of Justice announcing that it is probing 10 too-big-to-fail banks, including JP Morgan, Goldman Sachs, and essentially every bastion of financial evil on the planet for, drumroll please, manipulating gold prices. Frankly, I haven't even read the entire article, nor do I intend to, as with a 1,000% degree of certainty, nothing will come of it. And even if, by some modern day miracle, it does, as it did last year in Europe when Deutsche Bank was kicked off the London Fix and UBS paid regulatory fines for manipulating gold, there is not a chance it will impact the ongoing crime scene. What will impact it, of course, and terminally so, is when surging physical demand eventually swamps the phantom paper supply. But that story will be told another day, as today I simply want you to realize that gold manipulation is not only real, but the most important stabilizing factor in global financial markets today. Next up, a weak fourth quarter earnings report and abysmal 2015 outlook from bellwether retailer Macy's, which once and for all put to rest the propaganda that the holiday season wasn't so bad. To the contrary, it was the worst since the 2008 financial crisis, as validated by the negative retail sales numbers for both December and January, proving once and for all that the ridiculous government-published data claiming strong GDP and employment trends in the fourth quarter was exactly what I purported to be all along, lies. And that goes for the first quarter as well. And last but not least in my pre-FOMC horrible headline checklist, I want to follow up what I wrote in Monday's initial mining earnings essentially confirmed peak gold, not to mention yesterday's Audioblog, the aforementioned what's more fraudulent, mining reserves or resources or the Greek debt deal, which I'll do by noting an article that appeared in the Financial Post this morning titled, Barrick Gold's Production Poised for Another Steep Decline. I'm pretty sure you know where I'm going with this, but suffice to say, even I was shocked by what it discussed. Now recall the chart I posted in the aforementioned Peak Gold article depicting the world's 7 largest gold miners cumulatively anticipating lower production in 2015 than 2014. And for those like Barrick and Newmont that gave rough 2016 and 17 estimates, they too were anticipated to be lower. However, as I am not a full-time mining analyst researching each individual company's production profile, I had not a clue just how right I was until I read the aforementioned article about, by far, the world's largest gold miner, Barrick Gold. And here's what it says. Barrick Gold Corp's production was set to drop significantly in 2014, which it did, falling from 7.4 million ounces in 2013 to 6.25 million ounces in 2014. Barrick thinks it can keep production above 6 million ounces a year through 2017, and JP Morgan analyst John Bridges agrees. But after that, he expects production to plummet to around 4.5 million ounces by 2020 and fall even lower a few years later. Well, isn't that a fine how do you do for the company I characterized as evil personified in a March 2013 article? Yes, the mighty Barrick, which in 2002 admitted in court that it suppressed gold prices as a, quote, agent of the U.S. government. And even today, it is desperately trying to avoid bankruptcy by selling everything not nailed down. It expects gold production to plunge by an incredible 40% between 2014 and 2020, and then to, quote, fall even lower. And thus, my friends, I can only say this, that in a capital-starved business in which essentially zero material discoveries have been made in the past 15 years, with increasing exploration, development, and production costs, and incomprehensibly long timelines between discovery and production, there is not a doubt in my mind that global gold production has peaked. And the longer prices are held down by the cartel, strangling capital formation and bankrupting companies and sovereign nations alike, the larger the production shortfall will be. Let alone in silver, where plunging production levels will meet head-on with a bullion industry bereft of material amounts of available for sale inventory. Okay, on to Whirlybird Janet's mea culpa. Although care of rig stock and gold markets and a bought and paid for media will not yet be spun as the Yellen reversal it truly was, or if you will, Yellen reversal light, as only when QE4 is finally overtly launched will the two-year scheme of pretending the U.S. economy is recovering, the Fed preparing rate hikes, and its $4.5 billion balance sheet reversible will be dead and buried. But all in due time, my friends, likely much sooner than most can imagine. Anyhow, as I have discussed countless times over the years, said the mandated Humphrey Hawkins' biannual congressional testimony by the Federal Reserve Chairman has often been utilized by the cartel to initiate violent PM raids, most notably the February 29, 2012 Leap Day violation, when paper gold and silver were viciously attacked despite then Chairman Bernanke uttering absolutely nothing incremental about monetary policy strategy. For the millionth time, the Fed chairman rarely ever utters anything incremental in such sessions, instead preferring to do so on his or her own turf, i.e. the 8 regularly scheduled FOMC meetings each year. Not to mention, right after one such meeting was just concluded, in which it's outright comical to believe anything incremental would possibly be uttered. Essentially, the Fed chairman simply issues prepared remarks mirroring the latest FOMC stance and does his or her best to blithely answer Congress's moronic, uninformed questions as quickly as possible. That is, until today, when clearly a combination of rapidly weakening economic activity and the cushion of PPT-supported stocks at record levels, not to mention cartel-suppressed precious metals in the tank, loosened her carefully scripted lips in unprecedented Humphrey Hawkins fashion. But before we get to the unparalleled fraud and fear Whirlybird Janet displayed today, let's go over the pre-market action, of which the only major news, other than the fraudulent, credibility-destroying Greek deal, which had no material impact on non-Greek markets, was the aforementioned Macy's earnings report. And oh yeah, Gallup's Economic Confidence Index plunging into negative territory, validating the horrific consumer confidence number of last Friday at 96 compared to 103 last month and expectations of 99. Which came out, actually that came out today, simultaneously with Yellen's 10 o'clock a.m. prepared remarks. Not to mention the Richmond Manufacturing Index, which also published at 10 a.m. Eastern Standard Time, falling from 6 in January to 0 in February, validating not only yesterday's Dallas Fed manufacturing survey, which unexpectedly plunged from -4 to -11, but Friday's PMI manufacturing survey, which reported its lowest new orders component in a year, a sharply lower employment component, and an equally sharp drop in the 6-month business outlook. Somehow, the PMI service index this morning managed to surge, but frankly, it's hard to put much of any stock in such diffusion indices, as discussed in last year's article, the island of lies. That said, going into the 10 o'clock speech, gold was down about $5 an ounce after having been pushed below the cartel's blatant line in the sand at $1,200 an ounce relentlessly for an entire week. Stock futures were, of course, higher. The 10-year Treasury yield sat at 207, down from yesterday's 2.11 close, and oil at 49.75 was slightly higher as the oil PPT I've been discussing for the past 2 weeks again rescued WTI crude when it tried to fall below $49 a barrel. Silver was a nickel lower, again maniacally capped at $16.50 an ounce, and the dollar was slightly higher, with the euro again threatening to fall below 1.13, Greek deal and all. And then, it was published. Within seconds, stocks surged, as they are always programmed to do when the Fed chairman speaks, and gold and silver plunged, again, as they are always programmed to do. Nothing new there, and frankly, I don't even consider what has actually been said this soon, as frankly, the respective PPT and cartel algorithms are programmed to attack so rapidly, it's quite obvious no human has even read the statement yet. Okay, so there's your initial reaction to the statement, which I'll return to shortly. That is, after I return to the fraud the Federal Reserve has become. Which brings me back to its January 28th policy statement when it arrogantly pretended the oil, commodity, and currency crash, the Greek crisis, the ECB QE announcement, the Ukrainian escalation, and the general plunge in global economic activity, yielding countless ZERP, NERP, and QE announcements, didn't happen. But by then, she was already backing off the 2 meetings until a rate hike stance since she had inadvertently uttered it in her December 17th press conference. However, the FOMC's official statement feigned complete indifference to all the aforementioned factors, clearly under the assumption that since the PPT had so masterfully goosed the stock market, it could ignore economic reality. In other words, the Fed was showing the entire world that it was either lying or completely out of touch. In other words, it had become so accustomed to the success of its market-rigging teams, it felt it could get away with putting out pure lies, knowing full well the PPT, cartel, exchange stabilization fund, and its own open market operations desk could paint the picture it wanted, irrespective. Too bad it can't manufacture actual gold and silver, or actually improve the economy via jawboning, money printing, or manipulating markets. Anyhow, fast forward to the middle of last week, when the Fed had manufactured, even by its own standards, one of the most blatantly obvious interest rate surges to date. Again, the Fed is desperate to maintain its veneer of economic recovery and expectation of an eventual rate hike. And thus, before every FOMC meeting, minutes publication, or Fed chairman speech, rates magically surge higher. Of course, as I've noted countless times this year, including last week's The Fed Lied Audioblog, rates always plunge afterwards, and this week has been no exception. Before said minutes publication last Wednesday, the 10-year yield had surged from 1.64% before the criminally fraudulent January NFP report to 2.17%. But after the minutes revealed that the FOMC governors were literally lying through their teeth in the aforementioned supposedly hawkish policy statement of January 28th, the 10-year rate plunged below 2.1%. And with the 10-year rate down to 2.07% this morning, my guess is someone knew something about its contents. And lo and behold, it takes a lot to shock me, but in this case, I was utterly speechless. To wit, saying JY's statement was dovish is the understatement of the year, as more appropriately, per the title of today's audio blog, it was the most unequivocally dovish FOMC statement in memory. Frankly, it made last week's doctored minutes of the January 28th meeting look hawkish. And as noted earlier, the Fed chairman never makes incremental statements about monetary policy at Humphrey Hawkins' hearings, revealing just how terrified the Fed really is of the cataclysmic global economic and geopolitical environment. And oh yeah, right after the remarks were published, yet another monstrous API crude oil build was announced, causing oil again to plunge back to $49 a barrel, where it sits today at the close. Yes, I am now writing at the close. To that end, will the aforementioned oil PPT be able to repeat the blatant support of oil prices it executed the past 2 weeks, in both cases preventing oil from falling below $49 per barrel after equally massive inventory builds, in both cases to fresh 80-year highs? I guess we'll see tomorrow morning when the EIA inventory numbers are published. As for the Janet Yellen statement itself, I'm going to read some of the key parts to you here, so you can see just how dovish and moronic they are. And by the way, as smart as Zero Hedge is, beware of their real-time headlines, as sometimes they are dead wrong. For example, when the December 17th FOMC statement came out, you know, the one where everyone wondered if they'd take the term considerable time out, Zero Hedge's initial headline claimed it was taken out, when in fact it wasn't. Well, today's initial Zero Hedge headline was even more misleading in taking out of context a comment that a rate hike was possible at any meeting, when in fact that phrase could not have been more inappropriate given the statement's overall message. Let alone Zero Hedge's market comment that the quote dollar dived, when in fact it was higher against nearly all major currencies. Oh well. Enough Zero Hedge bashing for one day, as after all, it is the best financial media website in the world, outside milesfranklin.com, of course. And if it weren't for Zero Hedge, I probably couldn't do my job. That said, in my quest to report the financial and economic truth, there are no sacred cows. This is what the Miles Franklin blog is here to do, and in my view, no one does it better. Okay, so are you ready for a dose of the most pathetic, hopelessly dovish Fed speak ever? Well, here we go, starting with their boilerplate hedging, which has been present in at least the last 5 FOMC statements, in claiming, quote, the committee judges that a high degree of policy accommodation remains appropriate to foster further improvement in labor market conditions and promote a return of inflation toward 2% over the medium term. In other words, despite the so-called success, the headline unemployment rate plunging to 5.7% has been actually below the 6.5% level, I might add, that Bernanke claimed would cause the Fed to raise rates. It's just not good enough. How much better would be good enough, by the way? You tell me. But with a 38-year low in the labor participation rate, plunging energy business, and continuously plunging real wages, I'd guess much, much longer. As in forever, or at least until the fiat Ponzi scheme collapses, enabling the U.S. to jubilee its $18+ trillion of debt. All right, we're just getting started here, as next up we have this boilerplate beauty. The committee judged in December and January that it can be patient in beginning to raise the federal funds rate. This judgment reflects the fact that inflation continues to run well below the committee's 2% objective and that room for sustainable improvements in labor market conditions still remains. Now, for a second, just forget that your cost of living is going up by far more than 2% annually, no matter how you measure it. And consider that given the all-out collapse in energy and commodity prices and imploding global economic activity as evidenced by the all-time low in the Trump-Baltic Dry Index, there's not a chance the already understated CPI rate will print above 2% anytime soon. Likely not until hyperinflation inevitably arrives. In fact, as discussed in my must-read January 2nd article, The Direst Prediction of All, it's unlikely commodity prices will materially rise for years, if not longer. To that end, here's what the Fed's newfound dovishness, here's where it really kicks in, per this incremental statement added to the above boilerplate. The FOMC's assessment that it can be patient in beginning to normalize policy means that the committee considers it unlikely that economic conditions will warrant an increase in the target range for the federal funds rate for at least the next couple of FOMC meetings. Our first definition of patient, which in December was meant to be 2 meetings. But here in late February, with the second meeting about to be upon us, it now means at least the next couple of FOMC meetings, which in essence means no interest rate increases all year, despite the so-called recovery the Fed continues to propagandize, not to mention the 5% GDP growth in the third quarter. And now is where the statement gets really incremental and really panicked. Quote, if economic conditions continue to improve, as the committee anticipates, the committee will at some point begin considering an increase in the target rate for the federal funds rate on a meeting-by-meeting basis. Before then, the committee will change its forward guidance. However, it is important to emphasize that a modification of the forward guidance should not be read as indicating that the committee will necessarily increase the target range in a couple of meetings. Instead, the modification should be understood as reflecting the committee's judgment that conditions have improved to the point where it will soon be the case that a change in the target range could be warranted at any meeting. And hence, there's your Zero Hedge out of context headline. I mean, geez, just how many qualifiers do they need to add to assure us that not only do they have no intention of raising rates anytime soon, but they now intend to change their forward guidance, whatever that means, well before a meeting where they're even considering a rate hike? And don't forget, they emphasize, that even the forward guidance change doesn't necessarily mean rate hikes are coming, but instead that they are simply going to consider a rate hike, depending on subsequent economic developments, of course. I mean, again, how dumb do they think we are? And just how scared can they be? But the hits keep coming, as directly thereafter they take groveling and whining to new Fed speak lows in stating, quote, "It continues to be the FOMC's assessment that even after employment and inflation are near levels consistent with our dual mandate, economic conditions may, for some time, warrant keeping the federal funds rate below levels the committee views as normal in the longer run. It is possible, for example, that it may be necessary for the federal funds rate to run temporarily below its normal longer-term level because the residual effects of the financial crisis may continue to weigh on economic activity. As such factors continue to dissipate, we would expect the federal funds rate to move toward its longer-run normal level." I mean, wow. Now she's claiming that even if both unemployment and inflation reach the Fed's targeted levels, they may still not raise rates for an indefinite amount of time. And by twice mentioning the Fed funds rate's, quote, normal longer run level, I assume she's speaking of the average of roughly 6% over the 50 or so years prior to 2008. To that end, I'm just curious, is there a single person on the planet that believes the US could handle a 6% interest rate when it can't even handle zero? Next, onto the supposed policy normalization plan of raising interest rates and reducing the Fed's enormous $4.5 trillion balance sheet. To start, the boilerplate language present in essentially all FOMC statements, making the ridiculous claim that the Fed is omniscient and completely in control, i.e., the committee is confident that it has the tools it needs to raise short-term interest rates when it becomes appropriate to do so, and to maintain reasonable control of the level of short-term interest rates as policy continues to firm thereafter. However, after that ludicrous bout of ill-placed arrogance is where it really gets interesting, i.e., the committee intends to reduce its securities holdings in a gradual and predictable manner, primarily by ceasing to reinvest repayments of principal from securities held by the Federal Reserve. In other words, JY is actually trying to have us believe the Fed's $4.5 trillion of toxic assets will be reduced not by asset sales, but by simply allowing trillions worth of treasuries and toxic mortgage bonds to mature over a period of decades. Frankly, such a statement is so moronic and dripping with the Fed's fear of markets discounting the potential for asset sales, I'm simply going to let it stand on its own merits. Now, to that end, JY ends with the statement that says it all. In just 2 sentences crafted by nearly 100 taxpayer-funded lackeys, the Fed describes both its cluelessness and ineffectiveness to the entire world. Quote, "In sum, since the July 2014 Monetary Policy Report, there has been important progress toward the FOMC's objective of maximum employment. However, despite this improvement, too many Americans remain unemployed or underemployed, wage growth is still sluggish, and inflation remains well below our longer-run objective." Needless to say, stocks of course rose again, with the MSM and Wall Street no doubt claiming the Fed's dovishness to be the cause. Of course, if the statement was wildly hawkish, the PPT would still goose the Dow Jones propaganda average higher, only this time due to Fed confidence in the economy. As for interest rates, they did exactly as I predicted they would heading into last week's bogus minutes publication. Yes, they plunged into oblivion, with the 10-year rate plummeting from 2.11% yesterday to a close of 1.97%, en route, undoubtedly, to last month's 1.64% low, along with investors throughout the entire QE front-running world. As for the dollar, it was roughly unchanged, whilst oil plunged to $49 a barrel. And of course, there's gold and silver, which after 3 major attacks during the day, ended roughly unchanged. Gold, comically, closed right at the Fed's current line in the sand at $1,200 an ounce, and silver, after a 2% blitzkrieg waterfall at 10 a.m. Eastern Standard Time, was at the same $16.30 per ounce level it closed yesterday. Well, that's enough for now on yet another historic day of money printing, market manipulation, and propaganda. Unfortunately for the powers that be, the walls of financial and economic reality are closing rapidly on their best laid plans to create an alternative reality in which they are able to fleece 7 billion people on a daily basis. Consequently, the protection of your hard-earned savings with real money has never been more imperative. And to that end, if you decide